James, Horizon Kinetics has the Inflation Beneficiaries ETF, the ticker's INFL. So a lot of people are wary of inflation. How can your ETF help benefit from inflation?
Well, it's really about harnessing rising price levels. And so that means nominal growth versus just, real growth. And so if you own the right business models where their revenue is derived from the drivers of different inflation vectors through the right business model, that can compound for you through an equity, unlike the broader market, which may be negatively impacted.
Why don't we take a step back? How do you measure inflation over at Horizon Kinetics? Because some people measure it through the PPI, CPI, the cost of a Big Mac. How do you do it?
We look at a number of different underlying economic factors, and I think that it's idiosyncratic to every aspect of the market. And so rather than betting on CPI, PPI, PCE, we're looking at discrete secular growth in price levels, whether it be in energy, metals, power, real estate, infrastructure. And that's a much better way to harness this in a portfolio over the long term.
And you describe your portfolio as capital light, real asset. That's your strategy. What does that exactly mean?
So think about real assets. So whether it's a mine, an oil well, an office building, a bridge, costs a lot of money and a lot of time. And so that's a difficult investment unless it's fully contracted. If you can get all of those same attributes of those assets that I just mentioned, but with a business model that doesn't require a lot of upfront investment, very high margins, and then not a lot of reinvestment capex, that's more of a compounding vehicle than a yield vehicle.
So can you give me a few stocks that are in the portfolio?
Sure. We own a company called LandBridge, which is essentially a triple net land lease on a oligopoly of water management assets in the Permian Basin. We own a variety of financial exchanges, such as the Chicago Mercantile Exchange, where they're effectively a marketplace for the transfer of risk, whether it's interest rates, commodities, or currencies, but more throughput flows through to the exchange and cash flow to the investor. Another good example would be Brookfield Asset Management. So rather than owning office buildings and cell towers and bridges, you manage it on behalf of third parties at a very high margin.
And then finally, where does your ETF, the INFL, fit into a client's portfolio? Because if you want to fight inflation, you can buy TIPS, which goes under fixed income. You can buy gold, which goes under commodities. But what about your ETF?
At the end of the day, it's an equity portfolio, and equity has risk and volatility. So I think you have to look at it as equity, whether it's an equity substitute for real assets, which are very cyclical and rate sensitive, or you can look at it as a complement or a diversifier from broad-based equities, which are increasingly sensitive to technology, et cetera.
All right, well, thanks for coming on and talking about it.
Thanks so much for having me.